Module 1, Business Entities. General Partnerships. A general partnership is a type of business structure in which two or more people own and manage a business together. In a general partnership, each partner has equal responsibility for the management of the business, as well as unlimited liability for its debts and obligations. This means that each partner is personally responsible for any losses or liabilities incurred by the partnership. General partnerships are relatively easy to set up and do not require any formal legal documents. However, it is generally a good idea for the partners to draft a partnership agreement that outlines the terms of the partnership, including how profits and losses will be shared, how decisions will be made, and what will happen if a partner wants to leave the partnership. One of the main advantages of a general partnership is that it allows partners to combine their resources and expertise to start and run a business. In addition, general partnerships offer each partner a say in the management of the business, and profits are shared equally among the partners. However, one of the biggest disadvantages of a general partnership is that each partner is personally responsible for the actions of the other partners. This means that if one partner makes a mistake or incurs a debt, all of the partners are liable for it. In addition, any profits made by the partnership are subject to self-employment taxes, which can be a disadvantage for some partners. Overall, a general partnership can be a good option for small businesses with multiple owners who want to share in the management and profits of the business. However, it is important for partners to understand the risks and obligations associated with this type of business structure before entering into a partnership. Limited partnerships. A limited partnership is a type of business structure in which there are two types of partners, general partners and limited partners. The general partners are responsible for managing the day-to-day operations of the business and have unlimited liability for the debts and obligations of the partnership. This means that they can be held personally liable for any losses or liabilities that the business incurs. The limited partners, on the other hand, are passive investors who provide funding for the business but do not participate in its management. They have limited liability, which means that they can only lose the amount of money they have invested in the partnership and are not personally responsible for any additional debts or obligations. Limited partnerships are often used in situations where one party has the expertise and experience to manage the business but needs additional funding from outside investors. The limited partners are attracted to this type of investment because they can share in the profits of the business without being exposed to the same level of risk as the general partners. In order to form a limited partnership, the partners must file a certificate of limited partnership with the appropriate state authority and comply with any other requirements specified by state law. The partnership agreement must also specify the rights and obligations of each partner, including how profits and losses will be allocated and how the partnership will be dissolved. Limited liability companies. Limited liability company, LLC, owners are responsible for managing the business's day-to-day operations. The LLC's operating agreement outlines the management structure, which the members or a designated manager can manage. Members of an LLC are not personally liable for the company's debts or legal obligations, and their liability is limited to their investment in the company. LLC owners are responsible for managing the business and have limited liability. The members are all treated like the limited partners in a limited partnership in that they enjoy limited liability even if they participate in managing the business. The members who control the business are known as managing members. As with the limited partnership, forming an LLC requires filing paperwork with the state and payment of fees and, often, publication of the formation of the entity. Corporations. Corporations are business entities that are separate legal entities from their owners. The owners of the corporation, the shareholders, enjoy limited liability, as with the LLC. Corporations require filings with the state of their articles of incorporation and are managed according to their bylaws. The people who control the corporation are known as the directors, while the officers, such as the president, CEO, CFO, etc., manage the day-to-day affairs of the business. Standard corporations, known as C corporations, are taxed on their income as they earn it. Then, when corporate profits are distributed to the shareholders as dividends, the shareholders are taxed on that income as well. This, double taxation, is the major downside to running a corporation and is the main reason LLCs came into existence. However, because only corporations can be traded on most public exchanges, such as the New York Stock Exchange and NASDAQ, virtually all major American businesses are corporations. Profits. Profits are the financial gains earned by a business or an individual after deducting all the expenses from the revenue earned. In other words, it is the amount of money left over after all the costs of running a business, such as wages, rent, supplies, and taxes, have been paid. Profits are a key indicator of the financial health of a business, and they can be used in various ways, such as reinvesting in the business, paying dividends to shareholders, or saving for future expansion or emergencies. There are two types of profits that a business can earn: gross profit and net profit. Gross profit is the difference between the revenue earned and the cost of goods sold, while net profit is the amount left over after all the expenses, including overhead costs, have been deducted. It is important to note that profits are not the same as revenue, which is the total amount of money earned by a business from the sale of goods or services. Profits take into account all the costs associated with generating that revenue, and they are a measure of how efficiently the business is being run. In personal finance, profits refer to the amount of money earned from investments or other sources of income after deducting any expenses or taxes. It is an important measure of investment performance and can be used to determine the overall success of an investment strategy. Dividends. A dividend is a portion of a company's profits that is distributed to its shareholders as a form of compensation for their investment. Dividends are typically paid in cash, but they can also be paid in the form of additional shares of stock or other assets. Proportional dividend payment refers to distributing dividends to shareholders in proportion to their ownership stake in the company. In other words, the dividend payment is divided among the shareholders based on the percentage of the company's shares that they own. For example, suppose a company has 100 outstanding shares, a shareholder owns 10 shares, which is 10% of the company, and the company declares a dividend of $1 per share. In that case, the shareholder will receive a dividend payment of 10 cents per share, $1 times 10%. Similarly, if another shareholder owns 30 shares, i.e., 30% of the company, they will receive a dividend payment of 30 cents per share, $1 times 30%. Proportional dividend payment ensures that shareholders receive a fair and equitable distribution of the company's profits based on their investment in the business. It also helps to maintain the proportion of ownership among the shareholders, as those who own a more significant percentage of the company's shares will receive a correspondingly larger share of the dividend payment. After-tax dividend amount. The after-tax dividend amount refers to the dividend income remaining after taxes are deducted. When a company pays dividends to its shareholders, the dividends are typically considered taxable income. This means that the recipient of the dividend payment must report it as income on their tax return and pay taxes on it. The after-tax dividend amount considers the recipient's taxes on the dividend income. For example, if a company declares a dividend of $1 per share and the tax rate on dividend income is 20%, the after-tax dividend amount would be 80 cents per share, because $1 minus 20% equals 80 cents. This means that the shareholder would receive 80 cents per share in after-tax dividend income and would need to pay taxes on that amount. Calculating the after-tax dividend amount can be important for investors looking to maximize their income while minimizing their tax liability. By considering the tax implications of dividend income, investors can make more informed decisions about which stocks to invest in and how much income they can expect to receive after taxes. For example, assume a company pays all the profit they earn in dividends. Assume the company earns $8.30 per share before taxes with a tax rate of 21% on dividends, and further assume that the individual has a 15% personal tax rate. The after-tax amount the individual would receive is $5.58 per share. To calculate the after-tax amount an individual would receive from the dividend, we need to consider both the corporate tax rate and the personal tax rates on dividends and non-dividend income. Here is how to calculate it. First, we need to determine how much of the $8.30 per share profit will be left after the corporation pays its taxes. The corporate tax rate is 21%, so the corporation will pay 21% of $8.30, which is $1.74. This leaves a profit of $8.30 minus $1.74 equals $6.56 per share. Next, we need to calculate the amount of tax the individual will pay on the dividend. The personal tax rate on dividends in our assumption is 15%, so the individual will pay 15% of the $6.56 dividend, which is 98 cents. Finally, we need to subtract the tax paid on the dividend from the dividend amount to get the after-tax amount. The after-tax amount is $6.56 minus 98 cents, or $5.58. Double taxation. Double taxation is when corporate income is taxed twice, once at the corporate level and again at the individual level when the profits are distributed as dividends to shareholders. This means that the same income is taxed twice by two taxing authorities. For example, let us say a corporation earns a profit of $100,000 in a year. The corporation will pay corporate income tax on that profit, which reduces the amount of money available to distribute to shareholders as dividends. Suppose the corporation decides to distribute the remaining profits as dividends. In that case, the shareholders will receive the dividend payment, but they will also be required to pay personal income tax on that dividend income. In other words, the profits are taxed at the corporate level and then again at the individual level, resulting in double taxation. The corporation is taxed on its profits, and the owners are taxed when this profit is distributed to them. Double taxation is a common concern for businesses structured as C corporations, as they are subject to corporate income tax. To avoid double taxation, some businesses structure themselves as pass-through entities, such as S corporations, partnerships, or sole proprietorships, which do not pay corporate income tax. Instead, the profits are passed through to the owners, who report the income on their tax returns and pay taxes at their tax rates.